Welcome to Market Catalyst. I'm Julie Hyman. We got some breaking news now crossing the wire. We've got PCE, personal consumption expenditures, coming in line with estimates. This is for September, remember, so rising 0.3% on a month-over-month basis, 2.8% on a year-over-year basis. If you strip out volatile food and energy costs, you get a 0.2% increase, again, right in line with what estimates had been. And also, by the way, in line with what the prior month's increase had looked like. So pretty steady on the inflation front from a PCE perspective. We also got personal income and spending. And again, a reminder, these are September numbers because of the government shutdown. Personal income ticking higher by 0.4%. That is a little bit better of an increase than anticipated. Personal spending up 0.3%. So that's all the September data coming to us from the government, from the BLS. We also got University of Michigan sentiment, and this is a much newer number. This is the preliminary reading for December. That came in a little better than estimated, the headline number at 53.3. 52 is what economists on average have been estimating. Current conditions in UMich a little bit weaker than estimated at 50.7. Expectations a little bit better. So interesting here, we're also seeing moderating inflation expectations, both a year out and 5 to 10 years out. So put that all together, the Michigan sentiment numbers look relatively positive here. We are seeing the U.S. major averages tick a little bit higher on that, but we want to get a little bit more detail on what we're seeing in the markets today, both in reaction to this and more broadly. So for that, we go over to our markets editor, Jared Blickery, for more.
Thank you, Julie. Yes, it looks like if inflation is looking kind of benign right now. And to be fair, when we got those CPI numbers for September, a month ago, we could kind of figure out what these numbers this morning were. However, the University of Michigan consumer sentiment numbers, as you said, are new, and any reaction we're getting in price, which looks to be bullish right now, more likely off of that. And the inflation component of that, which is inflation expectations by consumers, that seems to be somewhat under control, at least not out of control. And here we see the Dow Industrials here up about 219 points for the day, up 45 basis points, or about 0.5%. Let's check out the NASDAQ as well. Also at highs, look like it's just exceeding that early high that it had after the open this morning. And the S&P 500, very similar to the Dow, up about 0.4% there. I will check in on the Russell 2000. That is in the red today after notching its first record high since October. And also, let's check in on the microcaps because they also got a record high yesterday. They were in the green early, is slightly in the red now. But as I've been saying, this is a time of year when volatility comes down. Here is the VIX. You can see it was briefly green there, but lower volatility is good. So you want to see that in the red. That means higher stocks usually. And let's check in on the bond market, which so far today hasn't done much. Just a fraction of a basis point higher, so not much change there. 10-year at 4.11. And then the 30-year, that is 4.77%. That's up about 1 basis point, not a big amount. I also like to check in on the US dollar. Barely moving there, a lot of chop. So let's check in on the sector action just before the report. Well, guess what? We look pretty similar right now. Communication services was the leader then, along with tech in number 2, and that is the status right now. Then you got materials up about 0.7%, energy and consumer discretionary all outperforming. So a lot of the cyclical sectors in the green here, although industrials looks like it's just kind of treading water. The only sector in the red is utilities. That's down about 0.2%. And let's take a peek and see what the NASDAQ is doing. After a nice day for Nvidia yesterday, I think it was up about 1 or 2%, slightly in the red today, but I did say communication services was leading. That is a sector where you have Alphabet, Google, up 1% here, and Meta up about 2/3%. And I want to show you a lot of the dark green on here is what's happening in the semiconductors. So let's switch over and see. There's Nvidia, that's down slightly, but for the rest of them, we got Intel up almost 5%, Micron up over 4%, Western Digital, Lumentum, those are up over 3%. So some nice dark green spaces there, and a pretty similar story in software, not quite as much dark green, but another strong day for Salesforce. That's up 3.5%, Adobe up 4%. And I'd like to check in on crypto too, as it can be at times inflation sensitive and sometimes reacts to some of these reports. Here's Bitcoin down for the day, 1.79%. Not really seeing much of a reaction here. So a little red to leave you off here, Julie, but not a huge movement off of those reports.
Jared, thanks a lot. Appreciate it. Well, as we just talked about, the September PCE report came in line with expectations, showing inflation rose 2.8% from a year earlier. That is, by the way, the fastest pace that we had seen since spring of 2024. It's also the last major piece of economic data to be released before the Federal Reserve's December meeting. Investors still expect the Fed to cut rates on December 10th. My next guest says the U.S. economy could be heading for a code red affordability moment. I want to bring in Ed Yardeni Research President. Ed, it's great to see you. I love
Thank
that.
you.
I love that blue there today, Ed.
Thank you.
So let's talk about the PCE that we just got. Obviously, it is dated, but I'm curious more broadly how you're thinking about the pace of inflation right now, reading the tea leaves between September and now.
Well, I think the data clearly suggests that we probably would have been down to 2% on a year-over-year basis by now, but for the tariffs. The tariffs did have an impact on inflation in durable goods. Durable goods inflation was actually falling on a year-over-year basis at the beginning of the year, and then it started increasing a bit, reflecting the tariffs. But that's probably a one-shot deal, and I think that looking into next year, inflation will come down from close to 3% to closer to 2%. So that's looking promising.
So that implies that you do think the Fed has ample room to cut then next week and beyond?
I think that's going to be their perception. I don't think they really need to. I think the economy is doing fine without rate cuts, and rate cuts increase the possibility of financial instability, particularly a melt up in the stock market, which are fun on the way up, but you have to remember to get out at the top. But look, the inflation news, I think, is going to increase the odds that the Fed will go ahead and do a quarter point. But it may be a hawkish cut. We may have more dissenters saying, what's the rush? We have more dissenters saying that maybe they should wait until next year for another rate cut.
And Ed, if you do get that hawkish dissent, obviously the market broadly expects the cut to happen. But if you get that hawkish dissent, if you get some of that, what then do stocks do?
Well, I think we could have a day or two where there's downward pressure to the extent that the markets are expecting that there will be another rate cut after December 10th, that there might be another rate cut maybe even as early as January at the next meeting. So I don't think it's going to be anything particularly earth-shattering one way or the other. I think the market's going to kind of continue to deal with some of the issues we have now with the horse race going on in the entire AI world and trying to figure out who the winner is today. So I think that kind of complicates that trade. And meanwhile, I think the market is going to increasingly focus on the likelihood that next year is going to be a good year for the economy again. We've got a lot of stimulus coming into the economy between some tax cuts, between the World Soccer, and then there's the 250th birthday of the United States. So there's going to be a lot of spending going on next year, and the market may be starting to anticipate that. It could be another really good year. I mean, I think we could have another double-digit increase in the S&P next year of maybe 10%. I think we'll end the year around 7,000.
And this year around 7,000?
This year, 7,700 by the end of next year.
And Ed, what about the affordability question, right? I mean, it sounds like you're a little bit more optimistic on inflation coming down.
Yeah.
And if that stimulus is coming in, does that become less of a discussion next year?
Not necessarily. The affordability issue is a little bit complex. It's also a little bit psychological. We have clearly had a huge increase in prices since the beginning of the pandemic, over 20%. The thing is, average hourly earnings, which is a measure of wages, has actually increased a bit more than that. The problem is it's comparing apples to oranges. The reality is average hourly earnings is exactly that. It's an average, and there's plenty of people below the average that haven't kept up with those big price increases. And then on top of all that, you've got young people coming out of colleges or people 20 to 24. Their unemployment rate has really almost doubled since last year. And so the code red is really the code red for the administration. They clearly have become very concerned that if the affordability issue is one that could sink their majority in the House.
How much room do they have to address it?
Not much, really. In terms of what they could possibly do. I mean, let's face it, energy prices have come down significantly, and that was always kind of viewed as a key view of what overall inflation's been doing. And yet people just still aren't happy with what they're seeing.
Well, I mean, energy in the form of gasoline has come down, but in the form of electricity, that's another story.
That's another story. And of course, the insurance policies for autos, for homes, life insurance have all gone up dramatically. So this is a problem, and I'm not sure that it can be solved by the administration in time for them to maintain their lead in the House in the midterm next year.
So, Ed, do you think that affordability is an issue from an economics perspective as well, or do you think it is primarily a political problem?
I think it's primarily a political problem, because we have seen that the affordability crisis probably has shown up in quite depressed consumer confidence surveys, and that in turn is related to the affordability issue. So I think it's more a political problem, because the reality is the consumer numbers have been pretty strong. The numbers you just reported this morning, they were okay. They weren't great. Up to 0.3 for consumption isn't really an increase when you adjusted for inflation. But 1 month doesn't make the trend. The trend is certainly for consumers to continue to spend, which is what they've been doing.
You mentioned what's going on with AI, and I want to just circle back to that, because you talked about the horse race that's going on with AI. Given that we sort of, instead of everything going up, we now have a little bit more, at least in the market recently, a little more dispersion among those AI names. Do you think that's broadly going to be supportive for stocks going higher, or do you think, as you said, it's more complicated now?
Yeah. Well, it's more complicated, but I see a happy outcome. For quite some times, the Magnificent Seven have been really the concentrated focus of the bull market. I mean, if they didn't exist, we'd still have a bull market. It just wouldn't be as impressive as what we've had with the Magnificent Seven. And for a while, they've been driven by the notion that they're all the winners in AI. Now it's recognized that it's become a lot more competitive, and it's maybe what this really means is that the investors will start to focus on the what I call the impressive 493. The other stocks in the S&P 500 that are likely to show that these technologies, including AI, are being used to increase productivity, which in turn is very good for corporate profits. So a broadening in the market to the 493 makes a lot of sense to me.
And Ed, I know you and your team watch Bitcoin as well, and Bitcoin has had such an interesting relationship with stocks recently also. Yeah. So what's your outlook there, and not just for the price of Bitcoin itself, but also for the interplay?
Well, it's basically proven itself to be a trading vehicle, a risk-on, risk-off kind of instrument. It had a sell-off a couple of years ago, and then Wall Street came to its rescue and decided that they wanted to create ETFs in that area. Vanguard just kind of folded. They were saying that they weren't going to do anything with Bitcoin. Now they are going to do ETFs. And of course, we've got a very pro-crypto administration. So, it hasn't really been about fundamentals. It's been a kind of a lot of technical issues here. And then the Genius Act, which was passed in July, basically took away the transactions function of Bitcoin, because now we're going to have stablecoin. And stablecoin is a cryptocurrency. It is blockchain based, and it can be used for transactions very safely, I believe. And so that leaves Bitcoin basically as a store of value, and it's been one heck of a roller coaster if you're looking for a store of value that keeps going up and up, which is what gold has been doing rather than Bitcoin. So ironically, Bitcoin's been said to be a digital gold, and gold maybe is physical Bitcoin, and gold seems to be doing better than Bitcoin.
It does, ironically enough. Ed, thanks so much. It's good to see you.
Thank you.
Coming up, Rubrik shares are surging on strong guidance. We'll talk to the CEO next. Stay tuned. You're watching Market Catalysts. Rubrik shares soaring after it raised its revenue forecast for 2026. The cloud data management company also topped third quarter expectations with revenue up 48% year over year. Joining me now, Bipul Sinha, a Rubrik CEO, as well as our Yahoo Finance executive editor, Brian Sazi. Bipul, good to see you. And not only do we see that revenue increase and revenue forecast, but I know there's a lot of attention being paid to your annual recurring revenue cadence. And that's part of the reason why we're seeing the stock performance here. So talk to me about what some of the main drivers are. And in this IT spending environment, you know, where so many people are throwing so much at AI and compute capacity, how they're thinking about their budgets that affects you guys.
Thanks, Julie. So good to see you. We had a record quarter. In fact, this was our best ever. We not only exceeded all the guided metrics, but we also raised our outlook for the year. And it is driven by cyber resilience and AI transformation. What is happening in the marketplace is everybody is now rushing to prepare for the AI future. They are modernizing their infrastructure, they are doing cloud transformation, they are deploying agents, and they have to manage cyber risk because cyber attacks are inevitable and they need to prepare for a time when the attack happens and they can keep their services up and running. Because if your data don't have integrity or availability, AI will not be useful. And that's what is driving our demand. We are seeing secular demand in the marketplace. Cyber resilience is the number one cyber security category. And that's why if you look at our subscription ARR, that's how we measure our business, we grew 34% year over year to 1.35 billion. And we also generated 77 million in free cash flow, which is 22% margin. So we are not only driving hard and growing fast on the top line, but running a very disciplined operation.
Bipul, good to see you. AI agents, since we last spoke, the development of AI agents only continues to pick up. Are these things safe?
Obviously, agents without the guardrails and a way to govern is not safe. It's kind of like hiring 1,000 employees and letting them loose to write code, approve customer purchase order or refund. And you can imagine what could go wrong. And that's why we launched this new platform called Rubrik Agent Cloud. And this new product line is focused on ensuring that you can monitor your agents, you can govern your agents, and if they misbehave because of cyber or otherwise hallucination, you can actually push a rewind button and undo the action of agents. So we are focused on enabling our customers accelerate their AI future with a comprehensive Rubrik Agent Cloud platform.
At the same time, of course, the bad guys have the agents too, right? And you said on your conference call that AI agents in the hands of threat actors could inflict 10 times more damage in 1/10 of the time. So how at Rubrik do you guys stop that side of the equation from that infiltration?
Our basic thesis is you can't prevent the unpreventable. The bad actors will use AI, will use agents, and will inflict damage. So you have to spend money and prepare as much as possible in terms of prevention and detection. But you have to fundamentally assume that it will happen to you, and how do you ensure that your services are up and running? And you need to understand two things: the risk of the attack and how are you going to remediate it. And that's the comprehensive strategy that Rubrik has with our Rubrik Security Cloud platform that we are selling, and we are finding a lot of success around the world. And then with Rubrik Agent Cloud, what we are saying is that companies that are deploying agents, how do you ensure that your agents are behaving in the parameter and guardrails that you establish? Whether it's a read-only agent or read-write agents, or this agent can send email, but not to this user. All of that is fully automated so that you can deploy agents with confidence and take advantage of the AI opportunity without the risk.
Bipul, since we last spoke, there has really been a seminal moment in the model building industry. Of course, a lot of executives weighing in on the power of Gemini 3. Have you used Gemini 3? What is your take on this? And then because of how fast Google has developed this model, what does it mean for what you do in the state of the industry?
We use Gemini all the time. In fact, we have been using all the model. And it is very encouraging to see Google so fast woke up and really ran the race and stood at the front. And that actually shows the speed with which the whole industry, this whole AI model and everything else is evolving. And it's very exciting because our customers are looking to accelerate their AI future, take advantage of the efficiency gains, get competitive leverage. And so they are looking for us to deliver the right guardrail, right governance structure so that they can adopt AI faster because they see all of these things happening in the consumer space and they want to take advantage of it.
Do you think there will ultimately be one winner as far as these models go?
I don't think so. We will have different models for different use cases that you are already seeing. If you look at the coding, Anthropic has emerged to be the best coding platform, and their proliferation in the enterprise is very high. If you look at OpenAI, they have garnered a lot of consumers. So you will have different use case for different models. It's not no different than what happened in the hardware industry. You had a HP server and Dell server and IBM server, and they serve different purposes for different workloads.
Bipul, finally, you're about a year and a half out from your IPO now of Rubrik. And I'm just curious, any big lessons learned, any surprises for you as the CEO of a public company now that you've got a little time under your belt?
I'm glad that we went public. I personally believe that if you want to build a long-term company, you need to have two conflicting ideas in your head. One is about delivering short-term results quarter after quarter, while focus on long-term strategy and vision to continue to evolve the company and the industry. And just like any intelligent person who can have two conflicting ideas but still operate coherently, businesses have to learn that to be a long-term company. So I'm very glad that we are a public company and we hope to continue to execute well as a public company.
Bipul, that's really interesting and definitely counter to what you hear from some other folks. Thank you so much for joining us. Appreciate it. And thanks, Brian Sazi, as well. Coming up, we'll have some of today's top calls on Wall Street, plus the latest outlook for the tech trade. Stay with us.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. We're watching Meta, Ulta, and Humana. First up, Meta. A fresh call from Bank of America suggests that Meta may be getting more aggressive on cost management. According to the firm, Meta is weighing up to a 30% cut to its Reality Labs budget. That's the unit behind VR, AR, and the broader metaverse push. BofA saying that those cuts alone could add 6 to 7% upside to 2026 EPS, and that the company is also evaluating a 10% expense reduction across other functions. That could help offset rising AI investments. So the takeaway here is that after months of concern that spending was reaccelerating, this reinforces that Meta is still willing to flex on costs. BofA keeps a buy rating and an $810 price target on shares, which implies roughly 30% upside from current levels. Next up, Ulta. Shares are surging after the beauty retailer delivered a big beat across sales, margins, and earnings. The company also raised its full-year outlook. The stock jumping over 10% in early trade, its biggest move since May. Analysts called out broad-based strength across categories, with fragrance and skincare leading the way in Q3. Ulta added 35 new brands in the quarter, executed promotions more effectively, and continued to benefit from the broader health and wellness trend. JP Morgan and Barclays both lifted their share price targets to 647, saying that the quarter strengthens the bull case as Ulta continues to gain share and maintain pricing power. And finally, Humana. The company is trading higher after Jefferies upgraded the stock to buy, calling the setup, quote, attractive heading into a critical Medicare Advantage cycle. The firm says that Humana is poised for major share gains in 2026, forecasting 21% Medicare Advantage membership growth and projecting that the company will capture 35% of new applications next year. Analyst David Winley raised his price target to $313 a share, up from the prior $253, implying about 24% upside from the prior close. The stock has lagged so far this year, but Jefferies argues that high volatility churn and big 2026 share gains set up a cleaner, more compelling runway ahead. We'll keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching SoFi, Cloudflare, and Foxconn. First up, SoFi, the fintech firm looking to raise $1.5 billion through a share sale. That is weighing on the stock today as the company looks to issue additional shares, essentially diluting the value of the existing shares. SoFi looking to expand beyond lending into new products. A statement shows it intends to use the proceeds to enhance its capital position and for new business opportunities. Next is Cloudflare. The software company says it fixed an outage that hit everything from Zoom to Coinbase. The stock fell as much as 6% in early trading, but has since pared those losses. It's now up about a fifth, 1%. It's also, remember, not the first outage to hit the company in recent memory. Last month, a major outage at Cloudflare hit websites ranging from X to ChatGPT for several hours. Cloudflare software is used by hundreds of thousands of companies worldwide. It acts as a buffer between websites and end users to shield them from traffic overload attacks. And Foxconn, formerly also known as Hanhai, reported a 26% rise in its November revenue year over year. Foxconn, primarily known as the main contract manufacturer for Apple, but its largest business is now cloud and networking products, including AI servers. The latest numbers, a good sign for Nvidia, who the company partners with. Foxconn's figures might have helped soothe any concerns resulting from HPE, which reported lower than expected revenue. Well, Nvidia CEO Jensen Huang compared the growing AI economy to a 5-layer cake recently. He broke it down as energy, chips, infrastructure, models, and applications. So how can investors play all 5 layers and make smart picks beyond the traditional Magnificent 7 stocks? I want to bring in Tony Wang, T. Rowe Price Science and Technology Equity Strategy Portfolio Manager. Tony, good to see you. Thanks so much for being here. So obviously, one of the biggest spokespeople for AI generally is Jensen Huang. So when he sort of breaks down the different components there and also pushes back against the AI idea of an AI bubble, the market does listen to him. Where we are right now in this progression, how are you thinking about it through your investing strategy lens?
Yeah, well, I think that we're still relatively early in the build out for AI. I mean, this is a total refactoring of how things have been done historically. So I really think that the AI infrastructure build out is like the railroads of today. And so to me, what matters is that there's continues to be additional use of AI and this transition to agentic AI and eventually the physical world. So that's what I'm looking for in terms of the inference capabilities, powering a lot of new applications, the token profitability for the consumption. And then in terms of the training side, I think what matters is this, that the move to AGI is actually accelerating. And so I think we've seen a lot of encouraging data points along the way in the last few weeks.
And specifically also, what about the data points from the companies themselves in terms of profitability, in terms of revenue generation? What are you finding sort of most encouraging throughout that universe that illustrates return on investment?
Yeah, well, so when an industry is going through hyper growth, I think there's going to be a lot of capital chasing, and then there's also going to be a lot of competitors and players that enter the market, both existing and new. So I don't think the returns are going to be evenly distributed. So I think it's not surprising that some companies are making a lot more gross margin than others. And so to me, what matters is that you want to invest on the platforms that are able to provide a lot of value and capture a lot of value along the way.
Are you concerned about overbuilding at all?
I think that this will be cyclical. Just like anything in the world, nothing goes straight up to the right. But at the same time, I think that over the multi-year, I think we're just at the beginning of the AI kind of super cycle. And so to me, I think it's an inevitability that, AI agents work alongside humans that improves our productivity. But I do think that we have to monitor the cycle. And just like semiconductors, historically have been very cyclical, I think it's something that as investors, we need to manage through.
Tony, I think it's interesting. You sent us a list of stocks that you're excited about. And this is not to say that you don't hold others in this universe. But it's 4 stocks: Nvidia, Broadcom, Micron, and Microsoft. What I think is interesting about this list is that Alphabet is not on it, because Alphabet has been sort of catching fire a little bit more lately with Gemini 3 and Nano Banana. Why isn't it on this list?
Yeah, so I think that the Google is definitely going to be a beneficiary of this, and I would definitely have them on that list as well. And so to me, it's like multiple companies are well positioned, and it's not a winner take all. And if anything, I think that the market continues to be really large, and they're all doing a little bit different things to some extent. And so I think Google, continues to have a lot of digital properties it can leverage AI across. So, and the models are performing really well. But I do think it's going to be a kind of rotation of leadership among a small group. So I would have them on the list and think of them as like a good compounder.
I'm also curious to ask about Micron, because it's not just about Micron, it's more about memory pricing more broadly, which, as we know, has spiked here. So Micron sort of concentrating more in the high bandwidth memory, i.e. AI serving part of its business. What kind of ripple effect does all this have throughout the tech industry?
Yeah, so I think whenever you're going from 0 to 100, there's going to be bottlenecks along the way. And I think HBM is one of those. And so, the industry is kind of consolidated around DRAM. There used to be a lot of players, now there's only a few. And Micron, I think, is well positioned to capture that value as AI continues to proliferate and these GPUs need more HBM. In addition, I think the broader markets are probably going to be improved eventually. And so there could be like continued tightness in the industry, and you've seen kind of DRAM prices continue to go up. And so, I view them as like a key picks and shovel provider to kind of the AI race here.
And you talked about bottleneck. Of course, energy is another bottleneck that's been highlighted a lot recently, including by Jensen Huang in the comments he made in DC earlier this week. So is who's going to win from a compute perspective going forward at least partially going to be determined by whether they can get enough energy?
Yeah, it's definitely a key area of focus, I would say. I think it's more of an engineering problem that with enough capital and brain power that the industry figures out here. And so, but it's definitely like, when you're scaling from, this level to what we need in 10 years, energy is definitely a key bottleneck. And so there are several companies in the supply chain that are kind of well positioned, I think, in that picks and shovels category, like Vertiv, that benefit, based on the gigawatts that are deployed. But I do think that semis continue to be a real beneficiary. I think a lot of them, help with the power and cooling, like monolithic power. You need to cool the GPUs, and then there's also the networking aspect that you need to have better connections from GPU to GPU, like Arista. And so there's definitely, I think, a lot of companies that can benefit and that are really strong moated businesses here.
Tony, great to see you. Thanks for joining us.
Thanks so much.
Coming up, what growth in prediction markets could mean for sports betting companies like DraftKings and FanDuel. That's next on Market Catalysts.
Well, the betting market continues to grow with global sports platform Fanatics launching a prediction market platform. While prediction market Kalshi more than doubles its valuation since October. Here with more on the action in the competitive landscape, we got Jordan Bender, Senior Equity Research Analyst at Citizens. Jordan, great to see you, especially on set. Let's start there. So as that intro just referenced, you got a lot of news, a lot of headlines for prediction markets. Start big picture, Jordan. What are you seeing? What are you hearing in that space?
Thanks, Josh. Yeah, the pace that this industry is moving is incredible. It feels like every time I pick up my phone, there's some sort of news event, news story, partnership agreement with companies within this space. So, the pace that this is going, it's hard to keep up in a way. I was with a major online gambling company yesterday, and they said 99% of the questions that they're getting today are around the prediction market. So, this week alone, we've seen Polymarket relaunch in the US, we've seen Fanatics launch, and it's just getting going.
So, all right, so bottom line, you got a lot of news, a lot of action, a lot of headlines. If I'm an investor, I'm watching this right now, I'm thinking, all right, bottom line, who's gonna win this? What do you tell clients?
It's a very complicated answer. I would say, from a...
You have plenty of time, Jordan. Take your time.
From a market share and a revenue perspective for sports contracts, our view is the traditional sports betting operators, DraftKings and FanDuel, they'll launch a prediction market platform in the next couple weeks. Those guys have decades of experience. They know how to build the mousetrap. They have the balance sheet. They have basically the UI UX that they know true sports bettors want to play on. Now, I'm not writing off anyone else in the industry. There are other ways to win. We've seen Kalshi and CNN integrate odds. We've seen you guys integrate with Polymarket. So there are other derivatives and other ways revenue-wise to actually benefit from what's going on in this industry right now.
So FanDuel and DraftKings, by the way, and I know you like both names. You tell clients, I think they're both buy. But if I push you, Jordan, and we say, okay, if we make the bet, they're going to be winners in this space, is there one you would say against this environment, this backdrop, that's a strong buy?
It's funny, going back to the 99% of questions go in the prediction market, like underlying fundamentals within the other parts of this business are still incredibly strong. And I think a lot of people are kind of missing that point right now with the whole prediction market cloud overhanging, if you want to say that, over the industry. So from a true fundamental standpoint, we like both companies. We think both are actually set up well for traditional sports betting, iGaming, as well as prediction markets. But if we had to go with one, we do like Flutter for its global scale, its diversity, and its balance sheet.
Are there other, if we're talking about the prediction markets, are there other winners? Are there other derivative winners you would call out?
Yeah, like I mentioned, there's other ways to generate revenue because the data is key here, and that's what's going to be king going forward. You listen to what ICE, they invested $2 billion in the Poly market, and the reason was not sports contracts, was the data that they actually derive off of that. So if your viewers can now watch, or on any media platform, they can watch in real time and learn in real time people's opinions by real wagering, that's a benefit, and then that's also B2B revenue for companies like Kalshi, like Polymarket. So we think that there's a long runway ahead. I'd also point to, I was with clients earlier today, and one of the conversations was, if you're long a stock into a print and you want to hedge yourself very cheaply, you can go to the prediction markets and essentially say they might miss earnings and hedge yourself to the downside. So there's kind of different derivatives off of this industry that we think are ways to basically generate revenue for a lot of different companies.
What about, I know we mentioned Flutter, DraftKings. I remember we spoke in the past, Genius is another name. Is that still on the buy list for you?
That's still a name that we like a lot.
How come, Jordan?
So they had an investor day yesterday. They exceeded kind of everyone's expectations in terms of financial targets. Just for reference, they have the data rights for the NFL. And it's a $3 billion market cap company. They have Roger Goodell get up on stage, commissioner of the NFL, and he's kind of saying how good this company is, what it does for the NFL, how it grows that game. So when you have the key infrastructure, the picks and shovels of the industry, like a Genius Sports in place, we think that's going to be a winner long term here.
Let's end here as we're looking at 2026 broadly. And you're talking about the sports betting market, the industry. What are the underlying themes and trends, Jordan? How just sort of healthy and resilient does it look as an industry?
Yeah. So going back to what I was saying earlier, the underlying fundamentals are still pretty strong. Now, there's been some bad game outcomes in the last couple of years. Sports bettors have been winning at a higher rate than normal. But as we look at sports betting, handle growth, the wagering still extremely strong. The pace of free money that they're giving out is starting to come down. So you're going to start to see that in higher growth rates for a company like FanDuel or parent company Flutter, which we like here. So underlying, sports betting strong, iCasino slots and tables on your phone, extremely strong. So those are going to be the winners long term, as long as these strong fundamentals continue in place.
Final question. We talk a lot about the macro on the show. And these concerns, Jordan, that are brought up about our labor market cooling, right? The K-shaped economy. How important is that to your coverage universe and the names we're talking about here? Yeah,
I'd say in the online names, it's a little bit different than if you say Vegas. You have to travel there. You need a big budget. This is, you might spend $5 on a given Sunday for an NFL game for 3 hours of entertainment. So we haven't gone through a recession since legalized gambling has been here in the US, but I would say, if you're spending a very low amount of money for that type of entertainment, it's going to be very resilient to what we're seeing in the economy. There's global instances of, during recessions, actually online gambling goes up. So I would expect that to be the same case here in the US.
Jordan, always great to see you, especially on set.
Appreciate it.
Thank you, my friend.
Coming up, we'll discuss ways to get your finances ready for 2026, including potentially changing banks. Stay tuned. You're watching Market Catalysts. A lot of us make New Year's resolutions to be more healthy, wealthy, and wise. So let's focus on being wiser with your money heading into 2026, including whether it's a wise idea to consider changing banks. Joining me now, Lawrence Sprung, Mitlin Financial founder and author of Financial Planning Made Personal, for this week's FA Corner, brought to you by Capital Group. Good to see you. Thanks for coming in. So, changing banks is an interesting thing to sort of think about periodically, right? I'm just thinking of myself. I've been with the same bank for 20-something years, or probably something like that. So why is it a good idea to maybe revisit that?
So I think things get complacent, right? And you look at, you may have went there for a promotional rate or something else that was taking place, and then over time, perhaps those promotional rates disappeared and you're not getting all those benefits anymore. But the challenge is that you have all your bill pays, direct deposits, and most people, the pain of disconnecting all that is more painful than moving it.
So what do you need to weigh you need to weigh that pain, but like what would make it worth it to go to a different bank?
So I think there are some good things that you can do now with maintaining that initial relationship that you have. And if interest rates, for example, are something that you're not seeing in your current bank, you could open a high yield savings account, link it to the current bank, move money back and forth. We have a bank that we use for high yield savings for our families that has a technology that says, hey, I want to leave $10,000 in my savings account, and the high yield savings account will look and audit that account every 2 weeks. And if there's less than $10,000, it will send money from the high yield back. And if there's more than $10,000, it will move it out of there into the high yield.
Oh, that's interesting.
So there are some really good tools out there that are making it easier to get better interest rates.
And in particular, it sounds like then you think people need to expand their conception, maybe especially if they're maybe older or they're at more traditional banks, to also think about some of the upstarts in the industry too.
I think so. I mean, at the end of the day, right, the safety is of utmost importance. People are at the bank because they want the FDIC insurance. So as long as that quote unquote upstart has FDIC coverage for those deposits, I think you're fine. And we've seen some of those upstarts that don't have the FDIC coverage, and we've seen some issues with those over the last couple of months, if not years, and you just want to be careful. But if that FDIC insurance is there, why not?
Yeah. Also at the end of the year, maybe a good idea to look at your spending, like how much you spent through the year, what the cadence was like, your budget. Is this a good time to kind of do that kind of thing?
It's always a good time. Carve out a couple of hours, take a look and say, okay, let's audit how much money do we have coming in every month? How much money do we have going out? And it's more important, where is that money going out? Is it going out to things that bring me joy and things that I am benefiting from? If not, cut them out. There might be a lot of things in there that you're not even using.
Right.
Cut those out. So it's an easy way to find that extra cash flow. And then you could talk about maybe redirecting it to retirement accounts, education funding, other areas where it might benefit you much better.
I mean, how many things have we all signed up for that you then kind of forget about, and it's the recurring subscription every month?
All the time.
You always happen.
I think everybody can find at least one of those.
We've been talking a lot here too about end of year, thinking about your tax liability, thinking about that positioning as you go into 2026. So what do people need to do on that front?
Yeah, so you have a couple weeks left to have an impact on your 2025 taxes. So it's something easy to take a look at and look in your portfolio. I mean, we've had a good year, so there aren't a lot of losses. But if you do have that investment that you thought was going to be a huge winner that turned out to be a huge loser, it might be a right time to sell that, take the loss, and offset some of those capital gains that you might have otherwise in your portfolio and have an impact on your 2025 tax returns now.
Is quarterly payments of taxes something that people should think about?
Yeah, I think it's most important quarterly taxes for those who are self-employed, those who have variable income where the taxes aren't being withheld, such as interest, dividends, capital gains from investments. It's important to make sure you're ahead of that, because as your viewers probably know, if you're not paying enough into the system and you're not doing that on a quarterly basis, you're going to get hit with a penalty.
Yeah.
And why give the IRS any more money than we have to?
Yeah, we don't need to do that. All right, thanks so much for coming in, Larry. Good to see you. And that was FA Corner, brought to you by Capital Group. Coming up in the next hour, we'll have full market coverage ahead, and we'll talk more about the Federal Reserve and those PCE numbers we got today. Don't go anywhere. minutes into the start of U.S. trading. I'm Julie Hyman. Let's get a check of the markets. Taking a look at the major averages here, we have them now rallying, and this was after we got some economic data here. So right now the Dow is up about 178 points. We've got the S&P 500 up about the same in percentage terms, about 0.4%, as is the NASDAQ. And as we say, this is after we got that economic data. The Fed's preferred inflation gauge coming in line with estimates. That September core PCE up 2.8% year over year. That data release was, of course, delayed due to the government shutdown. We also got at the same time consumer confidence numbers that beat estimates. And joining me now is John Hilsenrath, StoneX senior advisor and Yahoo Finance contributor. John, I don't know what your thoughts are on PCE, given that it is so delayed. I thought it was interesting. We talked to Ed Yardeni in the last hour, and he said, he thinks that inflation would be at 2% now, if not for the tariffs. But he seemed pretty confident that we'll be moving in that direction heading into next year. What's your current thinking around all of this?
I think I would take a different side of that discussion. My argument about tariffs for a while has been that the initial impact of tariffs would be muted because companies are spreading the effects throughout their supply chain. Their suppliers are eating some of it, wholesalers are eating some of it is getting passed on to consumers, some of it is showing up in profit margins. So we're not seeing big effects of tariffs in consumer prices just yet. But what the United States is going through is a reconsideration of the whole way that we do trade with foreign trade partners. And during a period of trade opening from the 1990s and 2000s, that led to goods price deflation, persistent, lasting over 2 decades. If we're reversing that, I think we're now going to have some persistent upward pressure on prices. So, my concern is that inflation stays a little higher than people are comfortable with for longer than anyone expects.
The Federal Reserve doesn't, well, at least the market doesn't perceive that the Fed is going to prioritize those inflation concerns next week, right? The market thinks that we're going to get a cut. Do you think, though, that we're going to get some significant dissents again amongst the Fed members that share some of your concerns?
Yes, I do think we're going to get dissent. I think we'll get anywhere from 2 to as many as 5 dissents at this meeting. And I think that's going to be a sign of what the Fed is up against and what the next Fed chairman is up against in 2026. There's a lot of disagreement at the Fed over a whole range of issues. So we talked about inflation. That's one problem. And the hawks at the Fed will point to that. But on the other side of the equation, the job market really has slowed down since the summer. The economy just isn't creating a lot of new jobs, and there's different reasons for that. Some of it is immigration, some of it is AI, some of it is uncertainty. But the result is the unemployment rate is rising a little bit, and job growth is slowing a little bit. And the doves at the Fed want to attack that problem. And then layered on top of all that, we have a lot of political change, let me say, going on at the Fed, which makes things even more complicated.
Well, and speaking of which, of that last point, John, I talked to one fixed income strategist yesterday who isn't overly concerned about, say, a Kevin Hassett leading up the Fed and about the Fed as a result being too dovish, right, cutting too much. Because he pointed out it is a committee, right, and you do have a lot of other people on the committee. How do you think about that and whether that will be enough of a check on whoever the next Fed chair is?
I think that the Fed is already under enormous pressure to run the economy hot. And I think it's going to be under even more enormous pressure to run the economy hot in 2026. And I think Kevin Hassett in particular is going to be under enormous pressure to run the economy hot. And there will be internal resistance, but I think the impulse of the Fed is going to be to put more emphasis on the job side of the mandate than the inflation side of the mandate. And for me, bottom line is we're not going to see 2% inflation again for some time. I think, you can attach a 0.5 percentage point premium to the inflation rate for the foreseeable future, because there's going to be internal resistance at the Fed, yes, but frankly, the White House is already pushing against some of this internal resistance. The Treasury Secretary has been criticizing, in particular, hawkish regional Fed bank presidents recently, who he says aren't even residents of the districts that they represent. He's pushing back on the regional Fed banks that are resistant to lowering interest rates. And then we're going to have turnover on the Fed board. That's going to be mean more Trump officials. So I think maybe people in the market might be underestimating the change that this institution is going to be going through next year.
Well, and then John, as well, I've been hearing an increasing drumbeat that even as the Fed cuts rates, we might not see that much downward pressure on the longer end of the curve, in part because of all of the issuance that's expected to come out next year, and we're running big deficits, et cetera. So you might see that sort of steepening of the yield curve. And I wonder if that then results in even more pressure coming, right? Coming if we're not seeing mortgage rates, for example, coming down in dramatic fashion.
Yeah, we run the risk of dogs chasing tails in Washington here. So I think you're absolutely right. For a number of reasons, one could argue that longer term interest rates could be rising even if the Fed is cutting short term interest rates. Let me go through a few points here. The Fed actually cut interest rates pretty aggressively in 2024 by a full percentage point. They cut the short-term interest rate, but long-term interest rates rose by an almost like amount. Because bond investors, if you're investing in a 10-year treasury bond or a mortgage debt or long-term corporate debt, you're factoring in not just the Fed, you're factoring in the risk of inflation. You're factoring in the effects of supply from treasury debt issuance. And I think all of those things could be pushing up long-term interest rates over the course of the next year, especially if the Fed is aggressive in pushing down short-term interest rates, because in theory that should cause some inflation, which if you're an investor should mean an inflation premium on the long end. So, and then the question becomes, well, what are they going to do about that if that becomes the next problem? Maybe the Treasury tries to issue less long-term debt. Maybe, just maybe, they start getting serious about the fiscal challenges that the United States faces in the long run. Then you get another dog chasing tail question. You got an election year. They're not going to be cutting back on spending aggressively in an election year. So we have a lot of challenges that we face in the coming year, but I don't want to sound too downbeat about all of this. We also have an AI boom going on. We have a lot of investment in technology. I think this whole environment is very friendly for asset holders, for people who have capital, for people who are invested in the stock market. It's a very good environment if you're invested in long risk. If you're a worker and there's inflation pressure and your wages are under some pressure and the unemployment rate is rising, it might not be a great environment. And that's the K-shaped economy that we keep talking about.
Indeed it is. A lot to chew on ahead of next week, John. We will be catching up with you again. Thanks a lot.
Thank you.
Coming up, President Trump expected to name his pick for Fed chair early next year. We're doing a deep dive into each of the candidates on the short list. Stay tuned. You're watching Market Catalyst. President Trump is expected to name a new Federal Reserve chair to replace Jerome Powell. We're doing a deep dive into each of the 5 candidates on the short list: Fed Governors Christopher Waller and Michelle Bowman, former Fed Governor Kevin Warsh, National Economic Council Director Kevin Hassett, and BlackRock Head of Fixed Income Rick Rieder. Federal Reserve correspondent Jennifer Schomburger here now with a closer look at the final pick on our list, Rick Rieder.
That's right. The 5th and final pick. Rick Rieder is a bond guy. He heads up fixed income for that mega money manager BlackRock, overseeing $2.4 trillion with a T in assets. He served as vice chairman of the borrowing committee for the U.S. Treasury, as well as a member of the Fed's Investment Advisory Committee on Financial Markets. Rieder spent a large chunk of his career at now defunct Lehman Brothers, where he oversaw the investment bank's global proprietary investment platform and headed its credit business. He holds a degree from Emory in finance and an MBA from Wharton. Reader thinks the Fed can and should cut rates next week. And in a recent interview with Yahoo Finance's Julie Hyman, he acknowledged that inflation is running higher than the Fed's 2% goal, but had this to say as well.
I have a stronger view that I think labor is a tricky thing from here, and I think there is significant displacement on labor that we're going to see over the next couple of years.
Excluding jobs created in healthcare, Reader says he believes that job growth has been negative in the spring and summer months, and he believes that is a trend that is going to persist, though he says he hopes the economy remains resilient. He believes the economy is in good shape now and that companies are in great shape, but that labor is a bit weak. Julie?
Jen, thanks very much. Appreciate it. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day. And we are seeing stocks rise across the board here as Wall Street digests that cooler read on the Fed's preferred inflation gauge, a report that's only fueling expectations that the Fed will cut those interest rates by the end of its meeting next week. You're seeing gains across your screen. The Dow up around 130 points, S&P up roughly 0.3%, the NASDAQ up around 0.2%. Like I said, rate cut bets pretty much held steady after that PCE reading came in line with expectations. So steady moves on the inflation front. If we take a look at Treasury yields, they're pretty much indicating that traders are continuing to price in those Fed rate cuts. We're up just slightly here. The 10-year is up around 2 basis points, trading just above 4.1%. The 30-year yield, same thing there, 2 basis points, hovering at 4.8%. I also want to get a quick check on Netflix because we've been covering this story all morning long. Really big moves in the media space. Now, Netflix's stock, it was down in early pre-market trading. We saw it come up from those losses, peaked into the green. Now we're down around 2%. And this comes after Netflix revealed that it is buying Warner Brothers studio and streaming assets in a deal valued at $72 billion plus debt. It's one of the biggest entertainment takeovers in recent history. And it's a dramatic shift for Netflix that has historically been more of a builder than a buyer. And it was a contentious few weeks leading up to today's announcement. We had Paramount and Comcast also in the mix. Paramount was really fighting for WBD. They had been bidding for the entire company, including those cable assets. But Netflix is just going to have the studio and streaming side once the planned split of Warner Brothers Discovery happens next summer. We will have those cable properties, which includes CNN, split off into a separate publicly traded company. So still a lot more to come here. Obviously, antitrust concerns hanging on this deal as well. So we'll see what the rest of media consolidation brings for the future. But for now, keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Now time for some of today's trending tickers. We are watching Netflix, Ulta, and Victoria's Secret. First up is Netflix. The stock has been whipsawed after winning a bid to buy the studio and streaming assets of Warner Brothers for $72 billion. Joining us for more, Yahoo Finance's Brooke De Palma. It's been an interesting journey for the stock today.
What a journey.
It started lower, then it briefly spiked higher after a report that there would be regulatory challenges. Maybe there was some relief because people don't want them
This is not actually going to happen.
And then it went back.
Yeah, and now we're starting to get some rhetoric from the street. Analysts really saying, Laura Martin over at Needham, she has a buy rating on the stock, and she pointed out a few things that strategically this would mean that Netflix will be the kingmaker in Hollywood, she said in her note. She also went on to say that this sort of positions Netflix to be able to compete with Google's YouTube. Keep in mind, Google does own a YouTube business. I feel like some people often forget that. Also, Amazon's Prime Video. So really, this positions Netflix, in her note, she says, to really go up against big tech. And Netflix sort of hasn't really been in that space as of late. They haven't been able to compete with these big mega players. This would put HBO Max underneath their umbrella and really sort of build out their robust. And she sort of said here that the valuation might be one concern on the street. Perhaps that's sending the stock lower today. But she said that she believes that Netflix overpaid only if viewed in a 1 to 3 year time frame. But when you think about Netflix over the next 2 decades, the valuation here makes sense.
Yeah, so interesting, and we'll see how it plays out in the coming days because it's not done.
Yeah, truly, this would be a historical transformation in streaming as well.
Definitely. Next up is Ulta, the beauty retailer seeing its biggest jump since May after boosting its forecast. The shares right now are up by 14%. Ulta, you've been following the retailer so closely, and it's been so interesting, the disconnect between the haves and the have-nots in a way, and Ulta's been doing well.
Yeah, Ulta's been doing well because, as we've talked about, I feel like over and over again, value continues to do well. People are ultimately looking for the best deal. And executives saying on the call this week that they know that they're up against this challenging macro backdrop, and so they're doing everything they can, especially around this holiday season, to continue to push their focus on value up against consumers as they really are mindful of their budgets heading into the holiday season. And Telsey Advisory Group saying that while macro visibility remains somewhat difficult in the near term, they're really confident about the momentum and relevance that Ulta's able to bring year to date. Of course, we know that the company has made many strategic changes over the past month, or rather year, including that change to get out of Target. And so it's just been really interesting to see the way that this company has repositioned itself and really ultimately gained optimism across the street this year so far.
Yeah, and finally, let's stick with retail and talk about Victoria's Secret, because that retailer posted better than expected third quarter results. It boosted guidance. Those shares are up by about 12% right now.
Yeah, and if you look year to date, the stock is up about 14% over the past year, up 10%. But keep in mind, over the past 5 years, this stock has severely underperformed. It's down about 14%. This company really trying to figure out how to revitalize itself, and it seems like it's starting to pick up some progress there, and that's what has the street excited. They raised their outlook for 2025 net sales, operating income, earnings guidance. Also, keep in mind, something that we went into the year thinking about is how these retailers would position themselves against tariffs, and that turned out that it wasn't as bad, or it's better than feared. And so Victoria's Secret said that the now estimated tariff impact would be about $90 million for the year. We went into the year thinking that it would be $100 million, and so this company definitely performing better than expectations.
Yeah, definitely, and you can see that obviously in the stock. Thanks a lot, Brooke. We have much more market action coming up. Stay tuned. You're watching Market Catalysts. Dollar General, Dollar Tree, and Five Below all reporting strong quarterly results this week as consumers continue to trade down. Yahoo Finance's Josh Lipton spoke to Anthony Chikamba, Managing Director and Consumer Sector Head at Loop Capital, about how to play the sector.
Look at these names, these reports. Dollar General, Dollar Tree, Five Below. There are some viewers, Anthony, who, maybe they throw them all in the same bucket. Can you help us understand what are sort of the big points of differentiation between these names?
Yeah, I think that's a great question, a great place to start. So think of Dollar General as almost like a small supermarket, right? All three of them are small stores, by the way, but Dollar General, it's about 75-80% consumable. So think food, household cleaning items, health and beauty care items, whereas Dollar Tree is about 50% discretionary merchandise. So they have toys, they have party supplies, seasonal items, 50% consumables. And then Five Below is, the vast majority of what they sell is discretionary. And what's different with Five Below is that Five Below is really targeted towards a teen and a preteen customer. Now, one thing with Five Below is the vast majority of what they sell is $5 and below. With Dollar Tree, the vast majority of what they sell is $1.25. With Dollar General, they have a much larger mix of price points.
Anthony, when you look through these results, I'm curious, what was your takeaway about the state of the American consumer right now? How healthy, how resilient? We keep talking, Anthony, about that K-shaped economy. Is that what you're seeing in these results?
Yeah, we're definitely seeing that. There's no question about that. Now, look, the low-income consumer is holding in there. They're not doing great, but they're holding in there. High-income consumers are certainly doing quite well. Everyone in the middle is definitely trading down. They're definitely looking to stretch their dollar. And I think that we saw that in all three of these companies' results. And to some extent, that trade down more than offset any weakness that we saw with the low-income consumer.
Let's dig into some specific names here, Anthony. So Dollar General, that one surging today. This is an interesting stat you highlight here. Now pricing about 12% above Walmart on average, widest gap you've ever seen. How sustainable is that, Anthony?
Well, to be clear, I mean, that might have been a bit of an aberration. I mean, normally what we see is that they're about a mid-single-digit percentage higher. So I don't want to read too much into one pricing study. And I will say, given the fact that they're just so much more convenient than Walmart, right? In other words, these stores are in your neighborhood. You don't have to drive 20, 30 minutes to get to the store. They're also 8,000, 9,000 square foot stores. It's not like navigating that 200,000 square foot Walmart. So they don't have to be at price parity with Walmart. They do have to be close enough for government work, as the kids say. And I'm not necessarily reading too much into one pricing study.
Why is that one a hold, Anthony? Is that a valuation call primarily?
You know, it's just real tough for me to get super excited about Dollar General. I mean, largely because I think, you know, if we were having this conversation a year and a half ago when Todd Vasos had just come back and there was clearly a lot that needed to be done in terms of the turnaround, I probably would have been more enthusiastic, but it looks like we're in the late stages of the turnaround. Now, having said that, there is still some room to go in terms of particularly inventory shrink and also damages. But it's just one of those ones where I really kind of feel like the turnaround is in the late innings, so it's tough for me to get super excited about it.
Let's switch gears, talk about Dollar Tree as well. You note they added 3 million customers over the past year, many of them making over $100,000. What does that customer mix indicate to you there, Anthony, if anything?
It's kind of where we started this conversation, right? I mean, folks are definitely looking to save money, and that's why you are seeing that trade down of those higher income consumers to Dollar Tree, and that certainly benefits Dollar Tree. There's no question about it.
What do you need to see to come off the sidelines on that one, Anthony? I mean, this one surged about 50% this year.
Yeah, so look, I mean, Dollar Tree, first off, they did sell Family Dollar, and that was definitely a major albatross for them. And they got $1 billion, which is about $1 billion more than a lot of folks thought they were going to get. Now, having said that, you know, when they reported results last quarter, they were just really, really messy. And the street doesn't like messy. This was a much cleaner quarter. So that was very encouraging to me. I also have to get more comfortable with the whole Dollar Tree Plus initiative, where they are selling more and more items above their single $1.25 price point. I am a little worried that they might take that a little bit too far and start to bump up against, you know, the Dollar Generals and the Family Dollars and the supermarkets, the convenience stores of the world. So that's definitely something I'm going to be looking for, in addition to just clean results like we saw this quarter.
All right, so hold on Dollar General, hold on Dollar Tree. Let's get to one you like. You're a fan of Five Below. I think you said here, Anthony, correct me if I have this wrong, I believe your favorite mid-cap growth idea. How come?
So a lot of it has to do with the fact that they brought in this new CEO late last year, Winnie Park. She is a merchant by nature, and their merchandising had gotten really, really tired, and she has definitely reinvigorated their merchandising. So they're focusing a lot more on newness. They are focusing a lot more on licensed products. So, you know, earlier this year, they really leaned into the Minecraft movie, Lilo and Stitch. More recently, they're really leaning into Wicked for Good. I think K-pop Demon Hunters is going to be huge for them. They did take some price, so they increased prices on 15 to 20% of their items. That helps them to offset the tariffs, and they still have a very long square footage growth runway. So, for example, last month they opened their first 8 stores in the Pacific Northwest, and those stores did incredibly well. So I do think, particularly relative to Dollar General and Dollar Tree, they just got a lot longer square footage growth runway.
Yeah, I mean, we're showing the chart there. What a move. I mean, the stock has surged about 50% this year, but you must think, Anthony, valuation still attractive here.
Yeah, the valuation is still reasonable. They're trading about, call it 26 times my fiscal 2026 EPS estimate. I think the best comps are more in the kind of 30 to 31 times range. And I think that my fiscal 2026 EPS estimate could ultimately prove to be conservative. So I do think that there's still some valuation upside in Five Below.
Remember when inflation felt like a 5-alarm fire just a few years ago? The flames are mostly out, but the Fed is still waiting for a few hot spots to cool down, like your rent, your healthcare bills, plane tickets, and dinners out. The big question now is whether this is just a last mile of a cleanup or a smolder that could flare back up. And on today's Stocks in Translation, we're going to use the Fed's favorite inflation report, the PCE index, to see how close we really are to declaring victory. Now let's start by breaking down exactly what we mean by PCE. The Personal Consumption Expenditures Price Index tracks what you pay for almost everything. That's groceries, rent, streaming subscriptions, plus what others pay on your behalf, like employer health insurance. You might be familiar with the more common gauge, the Consumer Price Index, or CPI. PCI is a little bit broader than that and usually runs a little lower because it gives less weight to housing. Now let's take a look at its history and the latest results. This chart here goes back to 2020 and shows the main headline figure for PCE in white and the so-called core number in green. That strips out food and energy components. The Fed likes to look at core because it's less noisy and shows the trend better. But the Fed's official 2% inflation target is explicitly tied to the headline number, which includes everything. Now notice in the middle of the chart those big peaks right here, as both inflation numbers surged above 5% to 40-year highs. The Fed hit the brakes hard in 2022, raising rates to combat this. And we can see that inflation has leveled off since, going sideways since early 2024. And according to the latest numbers from September that we got Friday, both headline and core came in at 2%, 2.8%, measured from 1 year ago or year over year. So they finally converged to the same level at the right edge of this chart. Now, let's also take a look at that dotted white line here, because that is the Fed's 2% inflation target. If both the headline numbers and cores are stubbornly sticking above that line as they are, well, this is then the Fed's last mile problem. And it's about the services that you can't easily cut, like your dentist, your insurance bill, and that plane ticket home for the holidays. Now let's break down the so-called supercore inflation. When the Fed was aggressively hiking rates in 2022, Powell kept pointing to core services excluding housing. That's what we shorthand as supercore. Think of it as a wage-heavy part of the economy: healthcare, financial services, travel, dining out, recreation. If wages are running hot, this is where you see it in prices. And now let's take a look at how supercore has run since 2020. And here's the backstory. Supercore surged to around 5% in the pandemic boom in the middle of that chart again, and has come down a lot. But we just learned it's still sitting around 3.3%. It's been going sideways since last year and has stubbornly remained higher than the headline and core PCE numbers, and much higher than the Fed's 2% general inflation target. And if you look inside the latest report from the BEA, almost all of the spending growth came in September from services, housing and utilities, healthcare, financial service, dining out. The stuff that you can touch, what we call goods, those were actually flat. So to put it all together, you've got paychecks creeping higher, people still paying for services that they can't ditch, and prices in those categories just refusing to cooperate with the Fed. So what should you be watching on the inflation front into year end? First, we got a big Fed decision out Wednesday, December 10th, and Wall Street has baked in a rate cut. So the drama itself is not going to be about the move. It's going to be about the split inside the room and what Powell says at the presser and how he describes the inflation threat. We've got a block of officials who are worried that cutting too fast could light up services inflation again. And another block saying, look, growth is cooling down, so we need to ease off the brakes. And then we get a number for November CPI on Thursday, December 18th. If it comes within expectations and doesn't change too much, the markets will lean into a bigger rate cutting cycle next year, 2026, especially with the prospect of a more dovish Fed chair after Powell's leadership ends in May. Finally, keep an eye on bond yields and rate cut odds. They are the real-time vote on how quickly the Fed can tiptoe from today's services stickiness to that new 2026 Fed that the administration would just love to lean dovish. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts up next.
Venture capital money has been pouring into artificial intelligence startups amid red-hot competition, but fintech firms are also pulling in capital, even going public. So let's get a read on the state of the industry. Joining us now is Nigel Morris, QED Investors co-founder and managing partner. Nigel's also the co-founder of Capital One, and he is invested and has invested in many fintechs that we know within this landscape. Thank you so much for being here.
Happy to be here.
Really appreciate it. So let's talk about the investment landscape, first of all, from the VC side, because certainly this year we have seen one of the most popular places for IPOs has been within fintechs. Do you think that's going to be the case next year as well? And are those the kinds of companies that continue to attract a lot of capital?
Yeah, you're quite right. In 2021, there were over 60 fintech IPOs. And then the last 3 years, very few. This year, we've had about a dozen. Some household names, Klarna, Circle, Chime, Figure. And they've all gone out in the last couple of quarters. I think the fourth quarter is going to be more muted. I think the backdrop of what's happening with rates and immigration and the shutdown in Washington has not helped. But I think that all of them have done somewhat well, and it speaks to the fact that there's a lot of investor appetite, both retail and institutional, for fintechs that have got to scale and are profitable and are growing very fast. So I think we will see some fintechs going public in 2026. I think we'll see more in 27 as fintechs are moving through the maturation cycle. But fintech is back in that 69% now of public fintechs are profitable. That certainly wasn't the case in 21. The revenue multiple's gone from about 3 to 5.5, over the last 2 or 3 years. So there's a sense that these companies are real, are at scale. And companies like Robinhood, of course, now are becoming household names.
It's been a really fascinating trajectory to watch some of these fintechs expand their offerings, their services over the past few years. And as somebody who's a veteran of not just the traditional financial industry, although Capital One was an upstart as well
it was
when it began,
once upon a time.
But also somebody who's invested in a lot of these companies. I look at the SoFis and Affirms and Klarnas of the world, or Robinhood, which is also expanding its offerings. And I wonder if you look 5-10 years from now, what share of financial services you think those types of companies will have?
Oh man, I think it's going to be very large. But you're quite right. Fintechs start with a single product, and they make that product work. They get the unit economics to work. They get the wonderful net promoter scores. They're solving a real customer problem, be it a consumer or a small business. And then from there, they expand. They go into analogous spaces of either on the asset or on the liability side, or both. And Nubank's a perfect example of that. That started with a lending product in Brazil, went to deposits and CDs, and went to wealth management, and built out a full range of lending products. And Capital One did the same thing 30 years ago. Capital One also went to Canada and the UK and France and Italy and Spain. So fintechs, by their very nature, are incredibly expansive. And we're going to see a lot more of that. If we look at the data, fintechs, which only represent 3% of all revenue in financial services, is actually 400 billion of revenue on 14 trillion, so 3%. If you look at the growth rates of fintechs, they're growing at 21% last year. Incumbents grew at 6%. If you extrapolate that forward, and I think fintechs are going to continue to grow a lot faster than the incumbents, then fintech represents 10% of market share in 10 years. So I think we're going to see a lot more of that. And then if I might add on, with that, we also have a generation of fintechs that have been developed overseas, who now have critical mass, who are very much eyeing the United States. Nubank, that has nearly 60% penetration of all Brazilian households.
Revolut. You're an investor in Nubank, we should mention.
Very early investor in them. Revolut, very strong in other geographies. Monzo, a neobank startup in the US, in the UK. And the US, in terms of market opportunity, the TAM, the total addressable market, is so much bigger.
Right.
So it beholds them to really look at the United States. So we're going to see more of that. Plus, the regulatory climate in the last 12 months has dramatically changed. So Nubank is applying for a banking license. We're going to see so many fintechs, both inside the United States and those that covet the United States, getting access to banking licenses that under the previous administration would have been implausible.
What is the appeal to a consumer, either a retail or a business client, of this new crop of fintechs? What are they offering to customers that traditional finance is not?
It's a great question. They are offering a seamless approach to solving a real problem that they have. Often much more transparent, often better pricing, and the ease of the user experience that's far superior, measured by net promoter scores. The fintechs that we've just been talking about will have net promoter scores that are 70, 80, and 90. Bank and insurance company fintechs are often 30, 40, 50 points lower than that. And it's very hard for an incumbent with incumbent management structures, incumbent technology, to be able to keep up with Klarna and Robinhood and Revolut, where they're so tech forward and move at a much greater speed with incredible agility. That agility now showing up, by the way, in terms of adoption of artificial intelligence, both reducing cost and improving customer experience, where the incumbents are struggling with, now how do I start to use these kinds of tools to make my business better?
How will I know as an investor who the winners are going to be within fintechs? Or is it better to sort of buy them as a group?
I wish I knew how to do that. If I could do that very well,
You've probably done pretty well at it so far.
A lot of being in the right place at the right time. I would look for traction, and ambition. And I think they're the two things to look at. If you can make the lending side of the business work, chances are you can make the other side work. Lending is much harder to do than it is the debit side of the portfolio. Do you have a real raison d'etre? Are you targeting a particular demography with a real problem? Part of the challenge of coming to the United States, particularly in the credit card business, is who needs another upscale credit card? Where there's JP Morgan and Capital One and Amex who are really focused there. I think we see still a tremendous amount of opportunity down in the near prime and subprime space, where the banks have basically de facto said we don't want to play in that population. So there we've seen the massive expansion of earned wage access. And of course, buy now, pay later, which are really focusing on that population. That population is hurting today. They are suffering in the economy and are nervous. So I think there's a real role for fintechs to play, to have a massive social purpose in reaching out to those populations where the incumbents are really not terribly interested.
Nigel, thank you so much for coming in. Really fascinating conversation. I appreciate it.
It's a pleasure. Thank you very much.
And that is it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.